You're listening to Capital Topics, episode number 72. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we'll discuss the investing lessons of 2024. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very well. And how are you?
I'm good, thank you. I will start. In our last podcast, number 71, we reviewed the capital market results for 2024. And by doing so, we underlined the main economic and geopolitical events that we believe shaped the capital markets results last year. Every year brings valuable lessons to investors that remind us of the importance of staying disciplined and focused on the long term and avoiding being deterred by the short-term noise. So James, let's continue our annual tradition of sharing investing lessons of the prior year, that is 2024.
Okay, so François, I'll jump right into it. As you well know, and most of our regular listeners, every year the markets provide us with lessons. Now, I like always reading what Larry Swedroe has to say, and he publishes his own lessons of the prior year. And he has this great quote, and I'm going to share it. With great frequency, markets offer remedial courses covering lessons they taught in previous years. That's why one of my favorite sayings is that there's nothing new in investing, only investment history you don't know. So today we will share our 5 main lessons from 2024. And again, in my preparation, I went back and reviewed our lessons for 2022 and 2023, and I was really surprised at how they resonate again this year. So again, most of our lessons this year are repeats from those 2 years.
Yeah, but unfortunately, James, too many investors fail to learn the lessons. They keep making the same mistakes over and over again. So let's start with this year's lessons. So number 1, no one is very good at consistently getting market forecasts right. We highlighted this in our last podcast about 2024 market results and how market forecasters from major financial institutions did last year. Their forecasts were just terrible. In 2022 and in 2023, we also said no one can forecast the future. We can't say it strongly enough. Avoid paying attention to all the 2025 forecasts and outlooks.
So, François, I'm going to repeat a quote from last year's podcast to help our listeners, and it's from Jason Zweig, journalist in the Wall Street Journal, and on December 16, 2023, he had an article titled, "Mirror, Mirror on the Wall, Who Knew Stocks Would Fall?" So, here's the quote. "Countless hunches and gut feelings flicker through our consciousness over the course of a year. We naturally remember the ones that turn out to be right. The multitude of other hunches that turn out to be wrong, wow, they kind of go into our mental garbage can."
Yeah, that's a classic. Many investors today need to do a reality check. In fact, they should make it an annual ritual. Another way of saying this is to tune out the noise. By doing this, you will give yourself the best chances of long-term investing success. There will always be uncertainty in the markets and headlines encouraging investors to engage in trading that may not be in their best interest.
Jason Zweig goes on to say, François, and I'm quoting, "This pattern, which psychologists call hindsight bias, makes us feel that we foresaw the future all along. What happened was inevitable, and nobody who didn't see it coming is a dope. It's close to irresistible, but it's an illusion." So David Booth, co-founder at Dimensional, wrote recently, and I think this is worth sharing with our listeners, and here's the quote, "Even with a clear crystal ball, markets are unpredictable. Against a backdrop of geopolitical tensions, economic challenges, and electoral uncertainty, 2024 proved the resilience of public financial markets and the power of human ingenuity once again." So markets do what they do best. They efficiently process information and set fair prices, rewarding long-term investors with positive returns.
Yeah. So this leads us to our second lesson. The valuations cannot be used to time the markets. Larry Swedroe wrote an article recently for Morningstar titled "U.S. Stocks Have Outperformed the World. History Shows That Success Can Be Fleeting." I quote him, With that said, it is worth noting the U.S. is now trading at about 2.7 times sales and 4 times book, the same multiples Japan traded at the height of the 1980s bubble. And international markets, in turn, trade at much lower valuation, about 1.2 times sales and 1.6 times book.
Okay, François, for many of our listeners, multiples of sales and multiples of books, a lot of jargon. What it really means is that U.S. stocks are expensive compared to international stocks. In addition, Larry is saying that about 75% of the U.S. relative outperformance has come from valuation changes. So it's not like their fundamentals are driving this. It's really the perception of what those fundamentals are worth and what people are willing to pay for them. So again, just a small percentage of the outperformance has been coming from the fundamentals.
Yeah, most of the U.S. market outperformance is a result of investors becoming more optimistic about U.S. equities. We can say that hindsight bias is at play and investors continue to project based on the recent superior historical performance. But investor sentiment can change rapidly.
Exactly right, François. With rising valuations, yes, it leads to higher realized returns, but they also result in lower future expected returns. So
correct.
The higher returns you're earning now are taking away from the future returns. At the same time, when other regions with comparatively lower valuations, think international equity, they can expect to achieve higher future returns, causing the pendulum to swing back again.
Yeah. So Larry goes on to say, while these cycles of out and underperformance are predictable at the high level, there are no crystal balls allowing us to foresee exactly when each shift will occur. The logical conclusion is that investors should be diversified internationally, holding a mix of both U.S. and international asset classes rather than betting on one to outperform the other, to capture the swings in valuation whenever they occur.
But unfortunately, François, being subject to recency bias or hindsight bias, many investors tend to buy what has performed best in the most recent period at higher valuations and therefore lower expected returns. And then they're more inclined to sell what has underperformed, which is trading at lower valuations and therefore has higher expected returns.
Yeah, well, that's the exact opposite of investing fundamentals of buying low and selling high. So now for lesson number 3, active management is a loser's game in bull or bear markets.
So here, François, I'm going to go back to Vanguard founder, the late Jack Bogle, and he captured the power of indexing with a simple analogy. He said, "Don't look for the needle, buy the haystack." So by looking back at capital market history as a guide, investors can see that concentration, and I think what we're living through now, Mag 7 stocks driving the bulk of U.S. returns. This has happened before in equity markets. So we did a podcast number 67 where last year where we shared the research of Professor Bessembinder. A small percentage, that is 4% of companies, have been responsible for half the equity market returns over the past nearly 100 years.
Yeah, another way of expressing what Jack Bogle is saying is take advantage of the benefits of owning the A-stacks, that is the broad market, and each of the needles, the individual stocks, in the market cap weight index.
Well, again, when he first coined this saying, François, most investors were either index or active, and overwhelmingly active. Today, many more people are passive. But this allocation of capital by investors resulted in material differences in the exposures and weightings of companies and sectors. Active investors typically held a smaller subset of stocks, that is, fewer needles. By owning the haystack or the broad market, investors have the highest probability that they will have market cap weightings that are derived by the consensus of all investors. Again, benefiting from the law of large numbers. This has been historically a very, very tough benchmark to beat.
Yeah, correct. James, I have another great quote here from David Booth, co-founder of Dimensional, that also supports Jack Bogle saying, and I quote, "Despite the overwhelming evidence and compelling story to the contrary, when economist Michael Jensen published his landmark 1968 paper, which showed that active stock pickers had no consistent value, other academics soon confirmed his hindsight. More than 5 decades and 50 years of data later, the theory still holds up. There are some stock pickers who experience success, but we don't know how to identify them before the fact. We can't separate skill from luck. Picking stock is more like gambling than investing.
Well, Larry Swedroe makes the case that 2024 was another year when active managers had a terrific opportunity to generate alpha. And that's just jargon for beat the market.
Right.
Through the large dispersion in returns between the year's best performing and worst performing stocks. He cites as an example the S&P 500 index that returned about 25% in US dollars last year, including dividends. And the stocks of the 5 best performing companies in the S&P 500 were up at least 135%.
Wow.
So to outperform, all an active manager had to do was overweight these big winners, each of whom outperformed the index by at least 110 percentage points.
Yeah. But unfortunately, James, investor in active funds continue to pay for the triumphs of hope over the wisdom and experience. Now for lesson number 4, diversification is always working. Sometimes you like the result and sometimes you don't.
Yeah. Well, this gets back to where you were mentioning, François, in our last podcast about the outperformance of U.S. equity markets. To be specific, the overperformance of U.S. equities relative to Canadian, international, developed, and emerging markets over the last decade, and especially last year, make us all question the benefits of diversification. However, there will always be a sector, a country, or something else that outperforms your portfolio in any given year.
Yes, and then when that happens, or when your discipline and patience is being tested, remember the reasons why you have properly diversified your portfolio in the first place. It's all about reducing risk without reducing long-term expected returns. Even in years like 2023 and 2024, a U.S. equity investor could be unsatisfied he didn't have all his eggs in the Magnificent Seven.
Well, François, while economic theory and empirical evidence suggests that the most prudent strategy is to diversify globally, it also must be acknowledged that for many investors, international diversification can be challenging to get their head around it. The reason for this is that even a well thought out diversified portfolio will inevitably go through periods of poor performance. Larry Swedroe says, and I quote him again, "The noise of the media will test your ability to adhere to your strategy. And sadly, when it comes to judging performance, it is my experience that most investors believe 3 years is a long time, 5 years is a very long time, and 10 years is an eternity."
James, it's critical for listeners to understand the logic and benefit of global diversification and the risk of diversification. There will always be what we call tracking error risk. Being aware you will have tracking error will help you better be prepared and stay disciplined.
I agree with you, François. Investors cannot run away from risks. They can only choose which risks they take. Failing to diversify globally creates the risk that U.S. equities might follow in Japan's footsteps to be the next country to underperform for the next 30 years. Putting all your eggs in one basket is not a prudent strategy, no matter how familiar you are with it or how closely you watch that basket. Another classic quote comes to mind, François. "Before making the mistake of confusing the familiar with the safe, no one knows which country or countries will experience a prolonged period of over or underperformance."
Mm-hmm. For an investor, weighting recent results over historical evidence would have resulted in poor decision based on recency bias. For instance, overweighting international stocks in 1990, U.S. stocks at the peak of the tech bubble in March 2000, or international stocks again in 2008.
I would add to that, François, that the latest academic evidence, and again, authors Asnes, Israelov, and Liu, in their 2023 Journal of Portfolio Management paper titled "International Diversification, Still Not Crazy After All These Years," they updated the data from their previous paper through to 2022, and they concluded international diversification does a pretty good job of protecting investors over the long term. And as we know, long term in the academic world is much longer than 10 years.
Right. So our final lesson for number 5 for 2024 is stick with a plan and maintain your investor mindset. There's no way to know where markets may be headed, and it can be hard to imagine an upturn when prices have fallen or when there's a lot of uncertainty about the direction of the economy. But history argues for persistence and patience.
François, I'm going to share another quote from David Booth of Dimensional. And speaking about last year's, market results. And he says, market performance in 2024 reflected the power of human ingenuity. The S&P 500 returned a robust 35.6%, that's in Canadian dollars, while the global stock market, as measured by the MSCI All Country World Index, was up 26.8 in Canadian dollars. Even bonds, after struggling earlier in the decade, delivered solid returns, 6.6% in Canadian dollars, as measured by the Bloomberg Global Aggregate Index. So we converted all these results into Canadian dollars.
Mm-hmm. The evidence here is clear. Investor with broadly diversified portfolios who stayed invested through the volatility of recent years were rewarded for their patience and discipline. A look back at recent history makes a case for sticking with a plan. Handsome rebounds like we saw in 2023, another strong year in 2024 after a difficult 2022, is a powerful reminder that investors must remain disciplined and focused on long-term and avoid being deterred, as we always say, by the short-term noise. This is the only reliable way to capture the long-term benefits that markets have to offer.
Which is why, François, investors may need an advisor more than ever to keep them on the right track and sort of not jumping from one thing or another based on the noise of the moment. So I think it would be useful to repeat a quote from Morgan Housel, the author of the book, The Psychology of Money. And we had shared this with our listeners, in 2023 in our Lessons of 2022 podcast. And here it is. Pessimism always sounds smarter than optimism because optimism sounds like a sales pitch, while pessimism sounds like someone trying to help you. The future is uncertain, therefore it is scary.
Yeah. We also remind our listeners, James, our mantra that they should have an investor mindset and continue to buy and hold investments with an owner's mentality. On that, thank you, James, for sharing your thoughts and expertise today.
My pleasure, François.
So that's it for episode number 72 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you would like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for next episode to be released on March 19th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon.